Welcome back to another episode of the Driven to Succeed Real Estate Podcast. I'm your host, Brandon Olson, and I have a special guest today in Kama Johnson from Arch Mortgage.
Hello.
And today we're going to talk about one of the first things we're going to talk about is the myth of putting 20% down. So before we get into that though, Kama, I don't even know this part of you. Like we've known each other for now 10 years,
Yeah,
but
long time.
what was your journey like? How did you get like you said, you didn't exactly seek out to be
Yeah, who actually plans to get into the mortgage business, right? How did I fall into it? It's actually an interesting story. I graduated from North Carolina State. I'm from the South, and I was in a marketing position. Actually, I worked for a public relations firm for a little bit. Then I found a marketing job at then United Guarantee. Which is what we used to be. And I used to help salespeople like me in the insurance world and mortgage insurance, just with flyers and marketing, sponsorships, trade shows, things like that. And then I'll never forget, I had an executive come up to me and say, "You need to be in sales." And at that point, I said, "Wait a minute." To me, sales was like selling vacuum cleaners door to door. And I'm like, "No, thanks. Would rather not do that." He said, "No, this is business to business." He said, "I think it's something that you could really excel at, and I think you should try it." So at the time, I was going through a transition in my life, and I was in Greensboro, North Carolina, and I decided to pick up everything, move to Baltimore, Maryland, and start my sales career with it, then United Guarantee. And then today it's Arch Mortgage Insurance. So here I am still. I'm in my 27th, almost 28th year with the company.
Wow. So we don't see that often where people stay with the same company
Right.
since
I always tell
college.
people, don't do the math. I started when I was 12. So nobody out
Right.
there do any math. Been there
What
a
it
long
would,
time.
it would look like it.
Right. Exactly.
There we go.
Right.
Well, I mean, that's interesting. It's to see that path
Right. Yeah.
and probably what you've seen along the way
So many
and
changes.
how many changes
Yeah.
and so forth. And well, going back to what I started with is that 20% down, right?
Right.
So I saw a while ago that there was a study or they put out a test at like Harvard about what do you need to have for a down payment uh, on a home for a
Right.
mortgage, right?
Right.
And I think it was like 80% or 75% said 20% down,
Yeah.
right?
Such a
Granted,
big
this is Harvard where
misconception.
they probably come from money for the most
Oh,
part
right.
already, so the parents have
Right.
drilled it in head, you need 20% down,
Right.
but one of the biggest myths in this industry.
Exactly. It's such a big misconception. And unfortunately, it's back in the day, even when I started, it was almost like mortgage insurance kind of got a bad name,
Hmm.
right? Just as realtors were like, try not to do mortgage insurance if you don't have to. But I really think that discussion has changed because now I think more people are using it as a financial tool. So you don't have to put 20% down. What can you do with that money that you would have put down 20%? Use it somewhere else. Use it, put it in the market. Use it to buy your furniture. Use it for renovations. So mortgage insurance is really for the greater good. If you think about mortgage insurance, so many people wouldn't be able to be in homes if it wasn't for private mortgage insurance today.
Correct. Well, and let's face it, a first-time home, even in Minnesota now, is $350,000 for a
Right.
single-family home on the
But
very low end,
yep. Right.
right? 400,000, 410 is like the median.
Right.
So 20% down of that is almost what it used to be for the cost of a home, right?
Exactly.
So
It's crazy.
it's not 100 grand for a home when it was $20,000 down,
Right.
right?
Right.
So obviously those things have changed, but it's increasingly harder if we look at statistics over the last 20, 30 years of that gap,
Right.
right? Of income gap versus cost of living gap,
Right.
right?
Yeah.
And
Affordability is tough.
yes, so if we go way back to when the 50s and 60s were a single like the traditional nuclear family where the father would go work and could buy a beautiful home and support the family on regular wages,
Right.
right? That's very, very hard to do
It's
these
hard to do.
days.
Definitely hard to do. So I think mortgage insurance really helps with that. So as long as great loan officers like you are educating the borrowers on their options of the different down payment options they have, I think mortgage insurance can really be a good tool for people to get into a home sooner and also keep some of their cash for other things.
Absolutely. I mean, it's So think of this too, and I see it all the time. And it's to be honest, the vast majority of loans are not closed with 20% down, right?
Right.
The vast majority is.
Yes.
And let's take a step back and you know, a lot of people don't even know what mortgage insurance really does, right?
Right.
Oh, it protects me.
Right.
No, it actually protects the lender,
Right. Other
right?
misconceptions. I get that question all the time, especially if I'm out socially or in social circles and I tell people what I do. I feel like their first question is, wait, is that the insurance that they pay off the mortgage when you die? I'm like, no. So definitely more of a niche market, but I always say it's one of those, it's a product that, yes, the borrower pays for it, but it protects the lender in case that borrower goes into default on their home. So that's why lenders like it, lenders slash servicers, because if something goes awry, if for some reason a borrower can't pay, that's when mortgage insurance steps in to help pay a claim if they go into default. So again, that helps with that greater good of our mortgage market. To help those people get into homes quicker and helps protect the servicers and lenders.
Okay, and to be clear, the claim would be if it goes into default and the home is foreclosed and then
Mhm.
it sells for a certain amount, but there's still a balance left. The
Correct.
mortgage insurance would
Attorney's
cover.
fees, real estate fees, mortgage insurance claims can help cover most of that. Yes.
Gotcha. Okay. Um, we were just talking about the affordability. So right now we can typically go like, you know, you have government loans have their own types. We're just going to stay with conventional today,
Okay.
but we can go down to like 3% down, right?
Right.
Then because there's Home Possible and Home
Mhm.
Ready programs. Those are specifically made for like lower income
Yep, a lot of first-time home buyer
first time home
program,
buyers,
things like that. Yep,
and then they have reduced cost for the
mhm,
mortgage insurance,
right,
even less cost than what a 5% down would be
right,
potentially,
mhm,
right? Um, so when I first started 10 years ago, the rates were getting better after coming out of and maybe let's talk about that a little bit, but
okay,
out of coming out of what happened after the
right.
'08 crisis.
Yes, that was a interesting time, as I'm sure many of us remember. Hopefully, never go back there again. So, yes, mortgage insurance, it got more strict. Definitely was more expensive back then. So, I tell people now that mortgage insurance is one of the only insurances out there that hasn't just gone up astronomically, right? I mean, it's I won't say it's the cheapest it's ever been, but it's really around that mark. So I tell people to take mortgage insurance and run because it's a great deal. And again, it just helps borrowers get into homes sooner. It helps them keep some of their cash, even for 20% down buyers. If you have a borrower who's already planning on spending 20% down, right? They have that saved up. Why? Why put all that into a place where you're not going to be able to access it? Do a lower LTV or a higher LTV but lower down payment, use the mortgage insurance, and then deploy your cash in other ways that can be helpful. Pay down your debt, put it in the market, you buy your furniture. Like I always say, there's so many other things to do with cash. Um, Mortgage insurance is a great deal today. So that's what I always say, take it and run.
Right. It's surprising how many people what the numbers can come back. If you have
Oh, for sure.
if you have great credit and maybe there's two people on the loan,
Hmm.
like the cost on like a $400,000 mortgage with 5% down, and you're showing them like $100 a month,
Right.
120,
Exactly.
$150 a
Actually,
month.
I think yesterday I just did a an example for somebody. It was like around a $450,000 home. They had 20% to put down, but they said, okay, what if we did 5%? And I think they were around a 740 credit score with two borrowers, which prices really well. The mortgage insurance came back around $106 a month. So if you
Right.
think about it, I always say the average life of mortgage insurance, because it does drop off for a conventional loan, it does drop off usually around that 5 year mark, give or
Mhm.
take. Depends on if you're paying principal payments down like you're supposed to, but usually about 5 years. So I tell my loan officer customers take that monthly mortgage insurance payment, multiply it by 60, right, for that 5 year. And it comes out on this particular loan, it was around $6,6,500. So over that 5 year period, they would pay around $6,500. So they wouldn't have to put down 20% on a
Mhm.
$450,000 loan, which is what, 90,000, 80,000. I mean, so it's crazy. So, I mean, again, just another way to deploy and use that capital that you have in another way.
Right.
So,
Now you take that and you put that into a money market, and where is that in 5 years,
Right.
right? Where
Exactly.
did that money go? I mean,
Exactly.
your net gain is huge on that.
Right.
And on top of it, if you have to have, talking about insurance, I just had an insurance agent on the other day, a few weeks ago, but where did homeowners insurance go?
Right.
Like
Oh,
it's doubled,
it
at least.
it's
A-
insane.
And
Right.
and if you have a roof that's older, then I mean, it's so hard, like for us quoting these payments for people, because
Right.
we don't know what it's going to come back at,
Right.
and we're always asking, hey, when's the roof been replaced, right? And
Yeah.
because that will really dictate what those costs are.
Yep.
But now you don't, if you have that extra 15% or 10%. I think most of the time, and when I've talked to like CPAs, they will too advise like, hey,
Right.
don't put 20% down.
Right. I
Um,
really feel like it's becoming more of a tool, of a financial tool for financial advisors, accountants, things like that, of a way to deploy your capital in other ways. So
right,
definitely not just a necessity
right,
anymore. It's
right,
more strategic in its use, which I
right.
think is great.
Yes, absolutely. I mean, it makes such a big difference. And everybody is different, because you do have people like, I just want the lowest payment,
Right.
period. So
Oh,
I
for
want to put
sure.
this 20, because they have it drilled in like, hey, we're going to pay this house off faster, and do everything, which
Right.
is that there's nothing wrong with
All
that
right.
whatsoever.
Yep.
Um, but keeping that, we can invest in Roth IRAs, the emergencies, hey,
Right.
if that roof has
Build
to be
up your
replaced,
6 month
let's just
fund,
let's
your
just say,
savings
yeah, let's
fund.
say
Yeah.
your roof is over 8 years old and you got a high insurance policy, and now you have a deductible, or hell does come through, and your claim isn't going to cover the majority of it. Where's
Right.
that money coming
All
from?
right.
Right.
Yeah.
And what I've seen too is I've had this, so many times people will say, well, I'm just going to wait till I have 20% down.
Mm.
Right. I'm like, well,
How many years are they waiting?
you have 7% right now. How long did it take you to get to that 7%?
Right.
How long are and I'm looking at their finances, and most of
Right.
the time I can tell right now, it's like, I mean, by the time you build that 20% up,
Right.
you've thrown away so much money in rent.
Exactly.
that
Right. They're paying their landlord's mortgage.
Correct.
So helping them out.
Correct.
Right.
So we just hit on this subject a little before the podcast. Is mortgage insurance going to be tax deductible potentially?
Oh, it could.
Right.
It could. It used to be tax deductible for different years. Congress and lawmakers would have to go and put that through every year, so it wasn't a guaranteed thing. And it hasn't been the last 1 or 2 years, but there is talk about it being tax deductible in the future right now with the lawmakers. So I always knock on wood. It is up to an adjusted gross income of 100,000, so it doesn't affect everyone, but even just some tax deductibility is always helpful, obviously, for any borrower. So we're keeping our fingers crossed.
Right.
We'll see what happens.
Okay. Let's see, because there's a lot of things in this big, beautiful bill that's
Yes,
coming
there's
out
a lot of things coming out. So
that are
we'll
ruffling
see.
feathers
There's
on
still
all sides of the
a
coin.
little ways to go in both, obviously the Senate and the House, but we'll
I,
see. It's
yeah.
definitely been brought up, and so the subject's out there. So we
Right.
will see.
Cancellation of PMI. So, like you said, so
Yes.
you see on your end, you see around 5 years, right?
Mhm.
But let's just say somebody puts down 5%. And I think the schedule is like 9 years. Let's say just mid the minimum
Yep.
payment, right?
Yep.
So the schedule is 9 years, and it will automatically drop off at 78% loan to value,
Correct.
and then 80%, at 80% you can request it. So
Correct.
can you give a little bit more
Yeah, I'll
insight on
clarify.
that?
Yeah, it's one of those clear as mud areas, unfortunately, but it's gotten better over the last couple years. It's gotten better for as clarification. So, due to the Homeowners Protection Act of 1998, at 78%, when they have that, the MI can be dropped. So the servicer just has to notify the mortgage insurance company, and then it will be dropped. But at an 80% LTV. So when a borrower has paid down their principal to an 80% of their original loan balance, they can go to their current servicer and request that the mortgage insurance be dropped. Now, that's when it's really up to the servicer. And that's where I'll have people call me and say, when will Arch drop the mortgage insurance for my customer? And it's not up to us. It's not our policy. Think of it as an insurance policy, right? It's your insurance policy. It's the lender's insurance policy. So we can't dictate when it's dropped. But each lender will look at each borrower situation at that 80% LTV. They might look at the value, they're going to look at their performance, but if everything is in line, they can let them drop the mortgage insurance at that 80% LTV. Now, where there's a little bit of a difference is when at that 80% mark, if they're trying to base dropping the mortgage insurance on their current value instead of their original value. So let's say somebody bought a house 6 months ago, has done a lot of improvements, and now they're saying, hey, now my house is worth this instead of this when I bought it. And we want to be able to drop the mortgage insurance. Well, you have to remember our mortgage insurance protects the lender. They're not jumping at the bit to get rid of it any sooner than they have to, because again, it protects them if something happens with that borrower. So again, the servicer is going to look at some things, look at their performance, look at the value, and if they are going to do that because of increase in value, they might make them wait. There's probably some seasoning there, 12 to 24 months before they might let them drop it. But again, it's always going to be up to the servicer and their discretion and their guidelines.
Yes. So when I bought my home, I had green carpet in my kitchen.
Okay. Oh, fun.
Yes.
Fun in the kitchen.
Yes.
That's a new one.
The original stove and oven, so it had a wall oven and the original stove from 1960.
Wow.
Like, literally range top with the oven. I mean, the oven was like.
Was it shaggy carpet?
No, it looked like
Green
hotel.
shaggy?
It looked like hotel carpet,
Okay.
right? Like an old hotel
Okay.
carpet.
Well,
So what I did, I knew I was going to be making renovations. So instead of putting 20% down, or like I don't exactly have the 20% at that time, but I did put 5, and then I took money and I renovated.
Right.
Right.
Great.
So when I did that, it wasn't that in that first 12 months. I think it was like about 15 months later when the renovation was complete.
Right.
So that's when I was able to go back and called my servicer
Mm-hmm.
and said, "Hey, I did updates." And they said, "Well, what did you do?" I said, "Well, I completely redid the main floor, kitchen, took out walls, the whole thing." So they said, "Okay, we have to order an appraisal." So they ordered an appraiser. Appraiser came out, and the appraiser was super cool. He's like, "Well, it the area I was in, this is in the middle of COVID too, there wasn't a ton of comparables
Okay.
for the on that
All right.
on that property." So he's like, "It's probably market wise is this," and he was very knowledgeable.
Right.
And he said, "What do you need to get to?" And I said, "Well," he said, he said, "I don't know if I could put 550 on it, but it's definitely worth 525. And is that going to work to get your 80%?" And I was like, "Absolutely."
Okay.
Right. And I didn't want the highest appraisal at the time too, because that does get recorded later. And
Right. Exactly.
guess what happened to my taxes?
Exactly.
Right.
Then it comes back in taxes. Yep. Exactly.
So
Pros and cons to
but
everything.
but that's how my process was,
Okay.
right? But it took 3 months for them to actually drop it.
Right.
But it was
Right.
took forever to get the appraiser out. But
Right. Yeah. And every servicer is different. They all have their processes that they have people go through. That's why, as a mortgage insurance company, we can't ever speak for them, right? When I have people say, well, can we guarantee that we'll be able to drop it? And we can never say yes. That's kind of why it's a little bit of a gray area, because it's just not up to us as the mortgage insurance company.
Right.
And every servicer, I mean, think of how many servicers are out there. There's a lot, and they can all have different procedures as far as what you have to do for cancellation, or what they're going to check on, like the appraisal or performance history, things like that. So that's why we just say it's always best if it's a real hot button with the borrower, which again, obviously anybody wants to cancel when they can, but always just make sure the servicer that the loan is going to, that what their process and procedures are for actually canceling the mortgage insurance.
right. Let's talk about upfront versus monthly.
Okay.
Because some people will elect to pay it up front, and you get a little bit of bigger discount. If you do extrapolate it out, it is a discount versus what it is monthly, correct?
Yeah, well, it just depends. It depends on the loan, the parameters these days.
Sure.
So I say back in the day, I don't know how many years because I've been doing it for so long, but it used to be single premium was a bit more discounted than monthly. But honestly, over the years, monthly has gotten so much cheaper that they're almost the same.
Gotcha.
But some people would just rather not see that mortgage insurance payment on their bill, right?
Right.
They just, if they have the cash up front and they want to pay it in one single premium at closing, then that's what they do. And some people, it's just a mindset. So what I tell loan officers to talk to borrowers about is that obviously every situation is different. Some people are going to have the cash to pay it, some people aren't. And you just do the math. Just obviously, if you calculate both the single premium, which is a one-time payment up front to kind of just take care of that mortgage insurance so you don't have it in your payment, versus monthly. Again, you can use that kind of 5-year rule, multiply that monthly payment by 60 and then compare it to that single premium amount to see what you're going to pay. They might be around the same. There might be a little bit of a difference. One might be a little higher than the other. But again, every borrower, it's not a one borrower fits all kind of situation. So you just kind of have to look at their situation and go from there.
Correct. I mean, there's the times that I've done it has been more of like, hey, we have a DTI problem, right?
Correct.
So we
Yep.
need to do an upfront policy. You have the cash for it,
Right.
and then it gives us the ability to do a
Some
little
wiggle
bit
room.
more house
Right.
because I've had people who are like, I love this house, but it's 485 and we were at 470, right?
Right.
How do we do this? Well, okay, we can do this and bring the DTA down too so that they can afford it.
Right.
Other ones, when we were in the lowest of low rates, like 3%
know.
interest rate, and like, now we don't see it as common because if, in the next 12 to 24 months, we see rates a point and a half lower, people are going to be
You're
refinancing,
refinancing.
right?
Yeah.
So if you
Sure.
pay that policy up front, that's gone.
Right. So you definitely have to, be leery of that just because you can't finance it right away because then they do lose that money. So you
Correct.
definitely want to keep that in
Yep.
your mind when
Yep.
you're offering that to borrowers.
So Arch has a product that I don't believe anybody else has anything like it. Is that correct?
Yeah, I'll say ours is the best. We've had it for, gosh, I think now 6 years now. And it's what we call our flexible it's kind of like a split premium product, but it's called RateStar Buydown because it is different. So it's been a great product for us. It's just a good tool for loan officers to have in their tool belt.
Right. So how does that work? So
It's basically where you can use some money up front to actually buy down the monthly mortgage insurance. So I always use an example of seller pays, right? Obviously, a lot of deals these days have seller pays that can be used for different things. And let's say in an example, you're working with a borrower and there's $682.17 left in seller pays that you as a loan officer want to make sure you use up, right?
Right.
Because obviously it's a benefit to the borrower. So now you can throw that $682 and however many cents up front to the mortgage insurance, and it can help bring down their actual monthly payment that they will see on their bill. It just depends, and every loan is different on how you do the calculation for that. It might bring it down a basis point, a couple basis points. You don't know because every loan is different, but it can just help reduce it. So you're using up those funds and also helping reduce their monthly payment as well.
Yeah, and that's because that's where it's always been the challenge. So for context, when we get a purchase agreement and say it's a $550,000 purchase agreement, 5% down with 3% seller paid closing costs, and we go with a par rate with no discount points.
Right.
Well, that 3% will probably cover everything and be left over. So
Right.
if it doesn't get caught, it could potentially give money back to the seller.
Right.
Well, that's the buyer's money
Right.
at this point. So
Exactly. You want to use it up.
we've had scramble. We've had, there's been times where it's like, oh, let's reduce the price, you're getting an amendment at the last minute to do this, or you're like, hey, well, let's throw like a homeowner's warranty in there.
Right.
And okay, well, it's a brand new house. Do we really need a homeowner warranty?
Right.
So
So what's better use of that money?
right. So being that's where I thought that was brilliant or best use for that. That I love that. Because in the past, split premiums would be like 50% or 25%.
Right. You kind of had to put a specific amount down as the upfront.
Right.
And that could be sometimes problematic for some people. So so this is, I call it our great flexible, we call it the deal saver because it's just a good program for, obviously seller pays is where I tell people that's always a big use, but I also have people use it where say they're right at that approvable mark, right? Say
Mm,
that are at a 50.2 on that DTI, and how can you get that down? So we use it for that as well. Sometimes there's just disclosure issues. Sometimes maybe a loan officer has already disclosed the mortgage insurance and it's gone through underwriting, and now homeowners has gone up, or now there's part of that self-employed borrower income that can't be used. So now the DTI changes and now the insurance changes. So a lot of things can happen and you might have to redisclose. So a loan officer can use it for that reason as well. So there's a lot of different uses for the product. So I always say it's just a really good product for a loan officer to have in their tool belt to bring out when it's needed.
absolutely. Absolutely. And be able to navigate that too, because I mean, it as a loan officer, done plenty of business and seen a lot of incomes change for one reason or another.
Oh, things always change.
And it's like, oh, we pre-approved you 4 months ago. We're under contract, and guess what happened, right? Oh, you took some unpaid time off, and now we have to average your income out.
I know everything changes.
Oh my gosh, like things just happen,
Yep.
right? So being able to, okay, we're at that threshold, right? 50.2, and we
Right.
got to get to 49.9 for it to approve.
All right.
Right.
Yeah.
So it works. But Kama, it's been great having you on.
Thanks for
You're
having me.
it's awesome always getting to meet with you. And I think this is great information for people that really don't know how mortgage insurance works.
Right. Well, I always say it's not the most exciting topic, but it's necessary, and I'm glad to help in any way. If anybody has questions, please definitely don't hesitate to reach out. I am glad to help.
Awesome. Well, thank you for coming on.
Thanks for having me. I appreciate it, Brandon.
All right, and please like and subscribe. If you have any questions about that, please reach out. I look forward to seeing you next time. Thank you.